Before we get underway, today's podcast is general in nature and not specific to your circumstances and should not be considered personal advice. Good morning. My name's Paul Nicol, Managing Partner of GFM Wealth Advisory. Welcome to our second podcast, a chat with David Leslie and Jayne, who are both investment directors of the Ellerston JAADE Private Assets Fund. I'll be chatting with David and Jayne about private asset investing and doing a deep dive into the Ellerston JAADE Private Assets Fund, which has just reached its 5-year return anniversary history, producing incredibly strong results. Good morning, David. Good morning, Jayne. So, David, let me start with you. Firstly, can you explain what private asset investing is and why you think investors should be allocating part of their portfolios to private assets?
Okay, thanks, Paul. So private asset investing is different from public markets where you can buy and sell on a daily basis. Private assets can be everything from infrastructure to property, long duration assets typically where there's limited liquidity and longer holding periods. One of the reasons we love private assets is unlike listed equities, which is the sort of comparative equity to where we play. If we're in private equity, listed equities, you don't have an ability to get behind the wall and see the inside workings of a company. But in private equity, you get to sit on the board, be involved with companies, and very much there's a lot of hands-on participation in what we do. So from an investor's point of view, increasingly we're seeing companies stay in the hands of private equity owners for longer. Public markets, probably we're seeing less companies list certainly over the last few years. And I think from an investor's point of view, you probably get better access to the underlying performance of the business with more hands-on management, which I think leads to more sustainable, probably better outcomes if you can over a longer period of time. And certainly that's the history of the market. I think there's probably an expectation of about a 5% better return being in private markets versus listed markets.
Yeah, interesting. So my next question, and perhaps a question for both you and Jayne, is what are, you started to touch on this, but what are some of the trends or the challenges or the opportunities that you're seeing in the Australian private asset market at the moment?
So I think we're seeing increasingly there's a world of massive capital sitting in the world of private markets. At the very big end of town, there's a lot of competition for assets, hence companies aren't getting listed. We've seen a lot of venture capital money, which I think is still being digested in the system. So I think you've got to really be careful about what your lane is within private equity and sort of stick to that. So we're in private sort of growth Australian technology companies. I think there's always competition from offshore capital as well as domestic capital. And I think, you've got to be true to your, what your DNA is, what your capabilities are. And that's why having operating partners in our business like Jayne sort of helps us to make sure we know what it is in terms of the capabilities that we bring and the businesses that we're looking to invest in.
And Jayne, do you have any further observations on Australian private assets and investing in that area?
Yeah, I think with Australian private equity, it wasn't available to all investors. It was quite, you had to have $1 million or $5 million to access certain funds. And I think it's now more accessible to the everyday investor. And that's one of the benefits of JAADE in terms of investors with smaller amounts of money can participate in these private equity and asset opportunities that haven't been available to them before. I think some of the challenges for private equity in Australia has been exits, particularly over the last 18 months with the IPO market being effectively closed. There's only been 2 really large IPO exits in the last 18 months. So I think it's an opportunity for diversification of investment for everyday investors. And I think it gives the opportunity to diversify your base.
Excellent. So, David, what are some of the characteristics that you're looking for when you're evaluating whether you're going to put one of these private companies into your portfolio?
Okay. There were 3 things we were specifically looking at. One of them would be we're looking for businesses that have IP and the ability to generate operating leverage. So that's businesses that, they're not just people-based services businesses where you're selling time and materials, but, you've got software, technology or a platform that enables you, as your business grows to show operating leverage and better margins. So for us, they're businesses that are scalable, that can be applicable to Australia, but hopefully ideally overseas. The second thing we're looking for is we're looking for long duration. There's no point, we're not looking for businesses that are cyclical in their nature, but we're looking for businesses that are forward-facing, future-facing. So, if you're talking about the world of healthcare, the businesses that are helping, healthcare be delivered remotely at distance in ways that aren't currently available today, but produce, more efficient outcomes for the customers. And then finally, if there's one thing that matters more than everything else, it's the people. You know, as you know from the business that you're involved in and the businesses and the clients that are often investing in these businesses, it always comes down to relating to the people. Like, you know, many of the companies that we've invested in have been around for 10 or 20 years. In many cases, they've not taken any external capital, but they've got to that point in their growth journey where they can see the benefit of having an investor come in to provide some growth and expansion capital. Maybe they want some capital to pay for the mortgage, to pay for some kids' school fees. But we're certainly not really fans of investing in a business where you might have a founder who's been at it for a year or two, thinks they're onto something, and they're still trying to really prove out that product market fit. So I think at the end of the day, if you've got great people who have got a few battle scars and a bit experienced, your ability to solve problems and generate good outcomes is materially improved.
And the size of the companies that you're looking at just in the portfolio?
Yeah. So to that point around, you know, we want them to be have proven they've got a product market fit. To us, it's about $10 million it becomes interesting.
Yep.
As someone once said to me, you know, the problem with small companies is they have all the problems that big companies have, but none of the resources to solve those issues. So at 10 million, it's interesting. The last couple of companies that we've invested out have been sort of 15 to 20. We've had other businesses where we've got involved where their revenues have already been close to 100. So again, we want to be investing at that growth stage of life. You know, we're not an early stage investor, but we're also not competing with the large PE firms that are at a later stage where, you know, businesses are more mature. We want that growth stage of a business that are growing at 30, 40, 50%, you know, 10, 20, $30 million of revenue. And we want to buy minority stakes. So one of our sort of points of difference versus the traditional private equity markets that most people are familiar with, the KKRs, the EQTs of the world, they're very focused in either getting control through owning the majority of shares or having debt-like instruments where they put the onus onto the management and founders of the companies. We take equity risk, so we like buying equity alongside founders, but, you know, we're only trying to find those 2 or 3 companies a year where by taking that risk, working alongside them, we can get that sort of, you know, 15 to 20% equity outcome that we're looking for.
So one of the things that fascinates me, David, is how do you find out about these opportunities of investing in private companies?
Yeah.
And I guess the adjunct to that is, what does the quantum and the quality of the opportunities that you're seeing look like at the moment?
So I guess people like Jayne who have industry expertise are often fantastic sources of deal flow ideas. And, you know, in our team, we've also got other people. We've got Jason, who's a GP by training. So we have specific areas where we go hunting and reach out and we look into deeply. We also have a lot of referrals come to us. You know, we're a relatively well-known investor in the space and people know where we play at that stage of life I described before. So it might be brokers, advisors, and we look at all of those deals. And often if they're presenting them to us, they're presenting to others. So there might be a more competitive landscape when we look at those opportunities. But equally, Paul, it might be you, your clients, who, you know, understand the way we think and think maybe there's a match with someone they know. So we also get a lot of warm introductions from our friends. And honestly, the more proprietary the opportunity is, the more we'll be willing to step up to maybe do a little bit of extra work, take a little bit longer, and even pay a slightly higher price if we feel like it's being built on a relationship rather than a really transactional process where a stockbroker brings around a deal and showing it to 20 different firms to try and get involved.
And the quantum and the quality of the opportunities that you're seeing at the moment?
Look, I'd say if you go back since COVID where we had this, you know, tidal wave of readily available capital, then the market obviously withdrew significantly. So there was, you know, a lack of capital available. As we're coming out of that into a point, I think we're in a more normalized market, which means that there's good deal flow, but equally good companies have always had a choice. So when we do see good companies out there, I don't think by any means there's a, you know, don't have that FOMO that was there maybe 3 or 4 years ago where prices were exorbitant. But you know, you got to be prepared to pay for. The biggest challenge we have is there's probably a normal deal flow, which means maybe 20 deals a month, but it's finding those 1 or 2 or 3 deals that we want to do a year. Don't spend too much time on the ones that we're not going to do, but really invest our time, energy, and effort getting to know the ones and convincing them that we can be a great partner. So, you know, so there's probably 6 deals a year that we look really seriously at, and we're hoping to complete a couple of those each year.
So one of the things that really interests me when thinking about investing in private assets is both the concept of valuation and the growth opportunity. And I guess my obvious question is, perhaps as a comparison when investing in private markets, when looking at valuation and growth, how does that look potentially against investing in public markets?
So public markets have recently appreciated, and it's interesting, in public markets, there's a premium being attached to growth businesses at the moment, which we've seen at different points in the cycle before. And so, a company like Xero, which is an interesting benchmark, and many of your investors may be familiar with the accounting software business, it's just reached its all-time highs. But guess what? Through the cycle, it's trading at the same multiple of its revenue that it has on average over the life of the company. So what we're seeing in the markets is there's a consistency to long-term averages. So that might be on companies growing at 30% or more, 6, 7, 8 times revenue. We still feel in private markets you get a 20 to 30% discount to that value that you see in public markets. So we're looking at businesses that are similar and paying 4.5, 5 times versus that 6 or 7. I think that test holds well. And as we go through some exit processes with other companies, we look to capture that differential between our private company valuations or the wholesale valuations, if you like. And then when we go to sell these businesses, which might be to a listed company or a private equity owner, and then you capture that premium, which might give you a 30% uplift from where we typically value the assets in our portfolio.
Fascinating. Jayne, I'm really keen to leverage off your expertise in the healthcare sector. So I think it's fair to say that one of the key investment thematics in the JAADE portfolio since inception has been healthcare. I'm keen to hear from you as to why JAADE, the JAADE team, is attracted to investing in healthcare and why that has been a key thematic running through the portfolio.
Well, I think healthcare is quite a defensive sector at any time, and at the moment, in terms of the economic cycle, it's a great area to be involved with. You've got to look at the market dynamics, the demographics, scientific development, technology development, disruption in healthcare, and where there's adversity, there's always opportunity. So healthcare is a great sector. Everybody will experience healthcare, and it's the number one priority. It also is very timely now with AI, machine learning. We've got issues with the labour force in terms of the migration, the ageing demographic, and also productivity. So people want to improve health outcomes, and obviously at a reduced amount of money. So the health economics are also pushing innovation in healthcare, and it's leading into innovative digital platforms, the way in which healthcare is actually delivered, and quite disruptive time for healthcare. And it's a great time to be in that sector. A great opportunity, good value proposition for the government, the funders, and also for the consumers who have to pay for the healthcare as well.
Yeah, fascinating. Well, I was going to ask you about the trends in healthcare, and you've already touched on that. But one of the trends that fascinates me is the role that technology potentially is going to play in healthcare. Do you mind just elaborating on that a little bit more?
Yeah, so everybody gets very excited about AI and machine learning. And what that really does is increase the efficiency and timeframes in which data can be interpreted. And, AI from a radiology perspective is a good example. There's a lot of people creating AI, but there's not many people making money out of it at the moment. So the way that I see AI in healthcare will benefit from a health perspective is in terms of reducing the labour side. So looking at ways being more efficient, instead of having 3 radiologists read, you'll have AI and a radiologist. So there'll be ways in which you'll get labour efficiencies in healthcare. Very exciting. You've also got scientific outcomes and clinical evidence. We've seen all the innovation with GLP and the reduction of obesity. So looking at improved health outcomes and the way services are actually delivered through an innovative approach. So it's going to be service and digital platforms.
Yeah, great. So let's get a little bit more granular with the portfolio. I'm really keen to talk about Mabel, which is a foundation investment of the Ellerston JAADE Fund. So firstly, can you explain who Mabel are and what the investment case for Mabel is?
Yeah, so Mabel addresses those two issues. It's a digital platform with service delivery to people in their own home in a cost-effective environment. So that's the premise of actually Mabel. And what it means is if I'm an elderly person at home and basically want to have aged care through a home care package, I can select the carers if I want an Italian-speaking nurse who's got the clinical authority to give, insulin. I can have my specific match to my needs in my own home in a cost-effective environment, which is very different to what the historical or traditional models of care were. So it's great for the consumer, and it's from an economic perspective, it means I can get more hours of care delivered in my home when I want, with who I want. Whereas in the past, it was you'd pay on average about $80 an hour for somebody to come into your home for an hour. You wouldn't know who they were. You wouldn't have consistency or reliability. Whereas in Mabel, the average hourly rate is about $42 to $44 an hour. For the workers, they can choose who they work with, when they work, and in terms of the clients that they choose to work with. So it's a highly innovative model. And the investment case was Jayde basically funded the partners, and they have grown the organisation over the last 5 to 6 years. It's been phenomenal growth.
Yeah, I think one of the things about Mabel that's taught us a lot, when I first, in the early days, I'd invested in Jayde, and then Jayne came along a year or two later because we recognised that we didn't have the clinical experience. We had the carers going into people's homes, and Jayne, with her background in healthcare, was able to come and make sure we put in proper process, risk management around how the business was scaling. And so I think, the investment case is this company's gone from turning over a few $100,000 a month. It turns over $30 million a month at the moment, right? It is a large business, and of its type, it's the largest company in Australia. And all the way along, there's been a very deliberate process around making sure that, yes, the technology scales, but the workflows and how we manage the risks around the business. And along the way, it's attracted some very large international investors, and we're having conversations to this day with big, large international groups. So as we think about the future of the investment, we're looking at what liquidity options might be available to the company. But it all comes down to, the market's incredibly large, the company has a real leadership position, and the business model's fundamentally scalable. And I guess when you're sitting on a really terrific investment, as much as there's a temptation to want to be taking money off the table to demonstrate that we're doing our job as fund managers, this is just a business that keeps growing at 30% a year. And the market has, whether it's in the disability or the aged care sector, there are new products and adjacencies that we keep adding to the Mabel business that mean we think it can double and double again from where it is today.
And I think in terms of establishing that business, I think the clinical governance and the regulatory framework that it operates in, I used to run hospitals many years ago. So clinical governance, risk management, it's basically had a very disciplined approach to that, and that's why it's quite unique. So you want to set up a company or organisation that you want to experience to that level of standard in your own home, and that's really, really important. So we've got that quality framework around risk management, structuring, and basically setting a sustainable home care product for the future, which is extremely important. And there's a great demand and area of need for it at this time.
Yeah, one of the things that as I understand, you both sit on the board of Mabel, and one of the things that fascinates me here, and I'll direct this to you, Jayne, is that through the answers to the questions I asked before, is how hands-on that you are in this business, which I think is a real differentiator of the fund. So do you get that sense, Jayne, that, you were brought to the board and that hands-on approach and the difference that makes to the business?
Yeah, well, I think clinical risk governance, as I said earlier, the standard you want is the standard you want for your own family in their own home at that time. And basically having ran hospitals, understanding the clinical governance, providing those basic needs in home, can be quite risky for people to consider. However, having the right regulatory frameworks in place around risk management, clinical governance, basically we're at the gold standard.
So Mabel's a business, because it operates in a regulated industry, there is constantly government departments, regulatory questions coming in. Paul, I can't tell you, I've never, been a part of a healthcare business before. And for someone like me, it's a really daunting thing as an investor sitting on a board. Jayne's like, got it, seen it before, know what the answer is, and also know how to speak to the people. So when someone turns up from the Aged Care Commission and says, I want to talk about how you're dealing with one of your clients, Jayne's like, not a problem. We answer the question clearly in this way, whereas people like us tend to reach for advisors. Having someone like Jayne there on the board is, for the founders and management, it's a great asset.
Yeah. It's very, very important to understand healthcare from a service and a consumer perspective.
Yeah. The investment case for Mabel and that scalability seems very attractive. I'll maybe direct this question to you, David. One of the things I'm fascinated in is the holding period of investment in the companies that you're in, and you've had this fund, this company in the fund now since its inception, which is over 5 years ago.
Right, yeah.
So is there not specific to Mabel, but maybe more broadly now, is there a sense of a holding period, or you don't tie yourself down like that?
No, look, we're pretty, I think from the outset, we've always said we want to hold businesses for sort of 3 to 5 years. Along the way, we've had General Atlantic, big US firm, come in, and we could have sold some shares at a valuation that would have been a nice uplift.
And this is in Mabel we're talking about now.
This is Mabel specifically. So I'll stick to that example for now. So in the case of Mabel, after 2 years, General Atlantic comes along, puts money into the company. Now, General Atlantic's putting $100 million into the company. Half of that was going to shareholders and half of that was going into the company. We made the decision at the time, they were coming in, putting more fuel in the tank. We knew the business would accelerate out the back of that investment. We could sell there and go, look at us, aren't we smart? We made a little bit of money. So we made the decision to continue to roll all of our investment. Now we've been there 5 or 6 years. We're a little bit more balanced. It's the largest position in our portfolio. It makes up, north of 20% of the fund. And quite frankly, if we could take a little bit off, it wouldn't be a bad portfolio management thing, because I think, we're all conscious of wanting to, make sure we can support the valuations with real cash. But also, portfolio management, it's also good to look for the next Mabel, right? But at the same time, to that bigger question of portfolio management, as Kerry Packer, who was, the famous Packer name behind Ellerston back in the day, said, if you're on a good thing, don't tell anyone about it. Mabel is a business that will keep growing for the next 10, 15 years. Care in the home, the technology that's been invested in it, just to prove a point that we made money and get off it. So, we don't want to leave the bus too early. We've got other companies that we're trying to get out of because we know they don't have that duration of growth profile. We want to have the best companies in our portfolio and not just be trading them for the sake of trading them. So, I think as an investor, I've been doing this for 30 odd years, and you don't often have the opportunity to get on board a business like this. So yes, we want to hold businesses around that 3 to 5 year period. Across the portfolio, I think that 5 year average will probably be about the right number. But if Mabel, which is probably the best portfolio position we've had, we hold it for 6 or 7 or 8 years, I don't think anyone's going to be disappointed for holding it for, through that growth period.
I think the other point with Mabel is its diversification as well. So they've had organic growth of Homemade, which is another business. They've just completed another acquisition. So they're diversifying their clinical risk, and that is compounding the ongoing growth. So it's a different business from where it was in the initial period. So, and we'll continue to evolve through organic and acquisitions and continue to grow. The fund and the way you value the companies that you've got in the fund. Do you mind touching on that a little bit?
So every quarter we value the assets. The process of valuing it involves us as a management group, and then we go to at Ellerston. There's the sort of the third party experts who come in and basically sit at a committee and sign off on the valuations. What we're solving for is when we carry the value of the assets in the fund, it really is at the wholesale price. We've got no incentive. We only get realized performance fees when we sell, and there are cash distributions. So what we want investors is over the journey to see that 15%, 20% annualized return without the volatility of being in public markets. And so we try not, through the cycle markets going up and down, we try to stick to those long-term average multiples. So leaving that 20 or 30%. So for an investor who's coming into the fund, they're buying into existing assets. If they want to leave, they're going to leave a bit of that embedded value on the table. And then as we have the realizations and exits and do the distributions, for the investors in the fund, they'll continue to capture not just the distribution, but the premium that comes out of a transaction that Focus is sort of looking at.
Great. So, Jayne, as we've already spoken about, you're quite hands-on with these companies. Are there any companies in the portfolio or any developments in the portfolio at the moment that you think are worthy of touching on?
I think I'd just like to say in terms of the healthcare opportunities, I've looked at about 6 in the last 10 days. Some, appropriate, some probably that won't fit Jade. But there's a lot of opportunities in the pipeline for healthcare, and hopefully Jade will do at least another 1 or 2 healthcare acquisitions in the not too distant future. I think one of the differentiations with Jade, the private equity team, is it is a partnership with those founders coming in, and we all do lean in. So, for example, on Mabel, if there's an issue around regulatory or risk, we lean in and work with the management team on an at-needs basis. We're not interfering, but we add value through our operational experience. Myself, Anthony, we've been founders. We've gone through the co-founding experience. We've had private equity investors come with us and join in the team. So we'll continue to look at healthcare investments coming in. We've just made one exciting new healthcare acquisition, which is a software. It's new, it's innovative, it's Australian-based and also in the US. So very excited to bed that acquisition down, continue to learn, evolve, and keep looking at the opportunities. But there's a large pipeline there for us at this time.
Yeah. One of the newer investments in the portfolio that caught my eye was a company called DataZoom.
Yep. So DataZoo is an interesting business. I know you had the chance to spend a bit of time with Tony, the founder. Yeah. A great story, an Australian company that had developed a digital ID verification solution that effectively payments companies use to verify who's making payments. Tony done a great job of taking an Australian business to doing almost $15 million a year of revenue, 100% funded out of his own pocket, and had clients in the US and around the world. At the time of investing in the business, Tony had already identified Charlie, who was an executive for the London Stock Exchange Group, who'd been involved in running large-scaled organisations. He wanted to come and be a little bit more entrepreneurial, but knew he was never going to start a company up. So he clearly sort of articulated he wanted to get involved in a growth stage business. So they effectively turned up as a package at the beginning of the year, and Charlie was going to take over as CEO. Tony's now the chairman of the business, and we put $30-odd million to work in the investment. And as you might expect in a world of cyber and ID fraud and digital verifications, there's just a phenomenally strong tailwind behind this industry. So in the first 6 months, there's been a few learnings, there's been a few customers come and go, but in the last couple of months, as Charlie's now started to get the US team in place, they're signing some really interesting clients. So Klarna has come on board in Europe. We've got other payment businesses, not just the PayPals of the world, Adyen, which is a European payments business. There's a range of companies that have all got the same problem around ID verification. When you're transferring money from one place to another. Now, in the US, this is a very well-established industry. Where they play is non-US clients trying to bring money back to the US. So we're really happy with the plans and the progress that they're making. Like every investment in the first year, there's a little bit of learnings from us. There's a little bit of learnings as you've got a new CEO taken over from the founder. And inevitably, there's a bunch of capital that needs to be invested. In order to take a business from $15 to $50 million of revenue, you've got to invest ahead of the curve into sales and whatnot. But the rising tide, whether it's social media platforms that are now got to verify that the children are over 16 years old, gaming businesses got to make sure who they're advertising to. ID verification is just a one-way trip and very, very powerful tailwinds. And this company does something relatively unique in how they use data sets to solve that problem.
So with DataZoo and maybe zooming out a little bit, historically Australian companies that have tried to penetrate offshore markets, it's been a graveyard. But it seems though that a lot of these Australian companies now and the ones that you're investing in do have the ability or have penetrated international markets. So it seems like you're very aspirational with DataZoo around the opportunity in the US.
Yeah. And I think this is one of the things that suits private companies. So when you can do this carefully, discreetly, knowing that sometimes it's going to take a little bit longer, you can spend some money, make a few mistakes, have a few experiments, but when you find what works, The moment that your revenues become significant in the US, because the market's, 10 times the size, it's that much bigger, the multiples on the companies go from 5 times to 8 times just by having a material presence in the US market. CAMS, which is an investment we exited earlier this year, we had a really good outcome on CAMS. We managed to get 3 times our money over a sort of 4-year period. But I can tell you CAMS, because of blasted COVID, never really got to its potential in the US market. And we needed to sort of bring that investment to the end because Joe, the founder, for all the reasons that, specific to the company, we wanted to have an exit and realization, and we did really well. But I tell you, the one bit we didn't unlock in that was that US revenue stream. If you can get any of our portfolio companies where there's 10, 20, 30% of their revenue coming out of the US, then the audience of buyers, the multiple they're willing to pay changes. So we're not experts at everything in terms of helping the founders to build US businesses, but I tell you, we do know a few of the playbooks, and a lot of that comes from taking the right people from a business. If you've got good executives in Australia, often, we push them very hard to, ship them over to the US, put them on the ground. Australians can't go over there without the help of some local talent to get the job done, but it will never succeed if you just think hiring expensive American resources is going to be the key to unlocking value. So that's a really common boardroom conversation that we have with our portfolio companies.
Yeah, interesting. So, look, it can't be all roses and wine. There must be some war stories here, or perhaps are there any positions in the portfolio at the moment that aren't quite performing as you would have liked?
Yeah, look, I think in most of these companies, so even take Focus for a minute. In the first year of Focus's ownership, we got to the end of the first year and they'd said they'd grow at 60%. They grew at 30%, spent a lot more money, and we ended up putting some more money back into the company. But so the founders did, and so did some of the management team. And lo and behold, the moment they did that, the business started growing at, 30%, but making money, and now we're exiting it very successfully. In every single company, we never invest and it turns out and goes up in a straight line. There's a lot of heavy lifting that goes in. The one that probably hasn't come out the other side is Prospection. And so Prospection's, it's a health-oriented business that uses healthcare data to provide real-world evidence around different treatments, drug treatments with different areas of sort of health and disease. So if someone's got prostate cancer, it'll look at other health factors in their life, and then it'll look at what different treatments produce different outcomes for them. Business went really well in Australia for many years, which is why we decided to invest in the company. And at the time, they had a large global pharma company who was a third of their revenues. A year later, that third had turned into 2/3 because this one global pharma had kept buying more and more products and services from them. And then lo and behold, they, had their own issues. They decided to cut off that investment. And so all of a sudden the revenues of the company collapsed. Unfortunately, they committed to spending a lot of money overseas and their cost base had gone up dramatically. So a year after that's all happened, I've been the chairman of the company for the last year. We've gone through bringing in a CEO, bringing in a CFO, and doing the best we can to right-size it. But the main thing we've done is we've brought in an investment bank to help us to sell the business. And we're at the final stages of negotiating a term sheet with a global company that's listed in Europe. And, they still see tremendous value in the platform. But because of the investment that was made at a relatively high price, well, even though we get our money back first before anyone else in the investment, we've already written the investment down materially. As we go to sell it, we think we'll more or less be able to get what we got out of it. But I think in life, sometimes, the one thing we didn't want to do was walk away and leave the business, worthless and sort of close down. So we've sort of nursed the business to a point where we can find another home for it. The founder gets to hopefully move on and continue the business somewhere else. But, and we get 50% of the money back that we invested in it. So not an ideal outcome. But when things go wrong, the hands-on approach that, that we have towards working with the companies, we've certainly got a few investment banking friends who are always keen to earn a fee. So, the playbook here was very much find a better home for it, get what we can for it. And it's taken us, the best part of a year, but hopefully we'll move it on pretty soon.
One thing you said before earlier, Jayne, that fascinated me was the sense of the partnership model and everybody leaning in. I'm the owner of a business. Business it's an emotional game, whether you like it or not.
Yeah.
And sometimes there are difficult conversations or are things not quite working as well as you'd like. So, it sounds incredibly collaborative, but how do you go when you're working with these founders who must be very emotionally involved in the business when difficult conversations need to be had?
Is Paul asking from his own self-interest, Jayne?
No,
I could be, David.
No, I think, I've been a founder myself a number of times, and I've lived it and experienced it. And the worst thing you can do is go in and tell a founder what they should do. You really need to work through the solution together. However, there are some times when you do really have to have the tough discussions, particularly around effective use of capital, using the right resources at the right time, the right people. And it's basically, having a discussion. And sometimes a robust professional debate is actually quite healthy. But I think that respect and trust and having been there yourself and identifying with their issues. And, you do learn through those adverse periods in business. There are those challenges, and knowing not to panic, work, listen, and try and get an outcome. And it's where there's alignment of values. And before Jayde actually invests in a business, there's a business plan that's agreed. And some of those tough discussions I had up front, are there too many family members in the business?
Yeah.
For example, always challenging, a whole range of those challenging issues, but they're agreed up front. So you know what the business plan is like. So hopefully for the first 3 to 6 months, you've agreed those difficult discussions, but it's never easy. You just got to have the honest discussion and be quite direct and upfront. But having lived and breathed it yourself and have that understanding, but it's never easy.
We never have FOMO about the deals that we don't do. There's plenty of great businesses that we had a chance to invest in that we didn't. If I went back 10 years ago, I had a chance to invest in Afterpay when it was an early stage private company. I couldn't understand it. The guys who were running it, they were clearly very bright. You're not going to get it. You're not going to get them all. But if you don't understand it, you can't feel like you're going to be listened to by the founders on the way going in. If you're only going to be a source of capital, life's too short. We only want to have 8 or 9 portfolio companies. And, we've been around doing this for long enough and, in our own careers as well as through the JAADE Fund. And you have to be able to get along with people. If you don't think they're going to listen, and one of the reasons we invest in businesses where pretty much we're the first capital going in and they don't have a collection of VCs on the register, where there are other VCs who have already invested, they've already sort of, made a whole lot of promises. And I think we find it challenging to come in on top of other investors to then provide a capital solution that might solve everyone else's problem. We'd much rather go in where we are the partner to the founder, to the founders, to the management group. And from the outset, there is that trusted relationship where, we're both in it together. We're not just providing you a financing solution. We want equity risk. We are going to wear some of the upside and some of the downside with you, and just make sure that's really clear. So it makes it easier to have those conversations that are sometimes a little bit awkward.
A great segue to my last question, as we're nearly out of time. The fund recently reached its 5-year return anniversary, and congratulations to you both on the outstanding results of the fund for the last 5 years. I guess the question is, how do you feel about the journey of the first 5 years of running the fund? And it's a question for both of you. And what are you hoping for, not from a returns perspective, but in terms of the way you see potentially the fund position in the next 5 years?
So for me, I think about probably 10 years, but, I break it into sort of 5-year segues. So the next 5 years for me, in order to be successful, we need to continue to build out our team. Over the last 5 years, very proud of the performance, but I think we've also been able to surround ourselves with people like Jayne who came along the journey, and there are other people that we've bolted into the team. But for us to continue to, deliver the results that we expect to, which is similar to what we've done in the past, 15 to 20% is very much where we want to be. We need to continue to attract and retain fantastic people who we want to work with. And then, I think when you make a commitment to work in a private equity business, you're not doing it for a 3 to 5 year view. You're doing it for a 5 to 10 to 15 year view. This is a slow moving, very deliberate kind of business, building a private equity practice. And, we need people who are making investment decisions over the next 2 or 3 years that will be harvesting over the next 5 or 10 years, which is why I've probably got a slightly longer term view. I'd be delighted if in 5 years' time we came back and we had, a virtually brand new portfolio of companies to what we have today. I'd be delighted if Jade as itself had delivered returns that are similar to what, that 15 to 20%. And I'd be delighted if the fund was probably twice the size. I think for us, we want to continue to invest great Australian companies. We want to be below the radar of where the internationals hunt. We want to be above the radar of where the venture capitalists hunt. And we want to pick those Australian companies where we can invest $30, $40, $50 million as a first-time check and grow those checks to, 50 to $100, $150 million positions, which gets us to that sort of $1 billion fund size over the next 5 or so years.
So I want to be aligned with organisations that invest in healthcare companies that are going to make a positive difference to consumers, patients, improve health outcomes through economic, cost-effective and basically make a positive difference into how healthcare is actually delivered, and also give significant returns to shareholders. And I think those values are mutually aligned. And Jade has a great team of operational and financial experience. And if we haven't got it in-house, we know how to source it, which is very important. And I think that practical side of it with the financial side, I think it's a strong foundation for the future, particularly for Jade.
Wonderful. Jayne, David, thank you for this morning. Thank you for your time and thank you for the wonderful work that you put in on behalf of our clients.
And for the last 5 or 6 years, thanks for supporting us, Paul. Appreciate it from you and your clients.
Thanks, Jayne.